Hello traders, Gary Wagner here just after 12 in Honolulu, 6 o'clock in New York. It is Friday. Happy Aloha Friday as we say on the island, June 15th, 2018, and this is the daily report for gold and silver, our weekend review, and what a week we have seen, especially the last 2 days of trading. The week ending on a sour note in terms of gold pricing down over $26, $26.30, taking an ounce of gold to $1,282. Silver hit even harder, losing 69 cents and closing at $16.57. And that's without help or hindrance from the U.S. dollar, which in essence was unchanged at 94.78. Subtle downside move in the Dow, 84-point loss at 25,090, and Bitcoin futures lost about $150 at 64.85 in the CBOE and CME futures exchanges. Traders, the last couple of trading days have been interesting, to say the least, and gold sell-off today was, for the most part, unexpected in terms of the extent of the sell-off and the underlying cause. Traders realize that beginning last week with the G7 meeting, we have had a series of events that we spoke about in our opening letter: the North Korean-U.S. summit, the FOMC meeting, and the announcement by the European Central Bank in which they will go towards quantitative normalization and end their quantitative easing program, all contributed to the activity this week. If we look back at what happened yesterday, we had a very interesting scenario in which dollar strength was in tandem with gold rising. Now, although gold only closed up about $5 on the day, that's after we factor in the dollar gaining about 1.25%, because prior to that, gold was trading up about $20 on the day if we take out the dollar factor. Now, today's activity is almost the exact opposite. We had extreme selling in the marketplace in terms of gold, and the dollar, although trading higher, was little moved. So as we spoke about in our opening letter, what was the underlying cause, or was it a number of factors? And as I said, I've come to the conclusion that it was the European Central Bank's action that was really the pivotal statement that caused what we're seeing today. And yesterday might have been the beginning of a knee-jerk reaction as traders digested all of the recent events, concluding with the ECB announcement yesterday. Gold, obviously under dramatic pressure today, selling off about $25 and closing at $12.82. Unfortunately, that did stop us out. We got in just above 1,300 and took about a $20 loss on the trade, an unfortunate consequence of the unforeseen action in gold pricing today. So the question now becomes, where is gold pricing going to head from here? And did today's move cause any major chart damage? I want to tackle the last question first. It did cause short-term damage, absolutely no doubt, but I'm going to show you a chart in a little bit that will explain why I do not believe that today's move caused major long-term chart damage. But first, to where I believe the market could go. When we look at the recent activity, out of the last, say, 10, 12 trading days, we have had 2 occasions in which unsuccessfully there has been an attempt to break back above the 200-day moving average. The most recent occurrence was yesterday, in which we had that huge dollar spike and gold spike at the same time. We absolutely have some really strong resistance at that price point, which comes in roughly between 1,300 and 1,308, which is the 200-day moving average. The former level of support, which held at about 1,288, also has been broken, so that on a short-term basis, we did create some damage, and the damage was a break below this critical support level. With that in mind, if we have followed through selling at the beginning of the week, we can easily target our next area of support at the 78% retracement level, which comes in approximately at 1267. A move back above on a closing basis, above 1288, could signal a return to a more bullish demeanor, but we'll have to see how the market follows through to this recent sell-off next week. And traders, the reason I believe that today's activity did cause some short-term chart damage, but no major long-term chart damage, is by looking at this weekly candlestick chart in which we have a series of trend lines, a longer trend line which starts the beginning of the rally which concluded the multi-year sell-off at the end of 2015 when prices went as low as 1040, and also aligns with this recent bottom that occurred at the end of 2016, beginning of 2017. We clearly have a ways to go and still maintain on this upward slope or long-term trend line. At the same time, when we look at a shorter-term trend line, we can see that recent activity, including this week's brisk sell-off and a little occurrence that happened a few weeks ago, did in fact cause some short-term chart damage. And traders, therefore, it is realistic to conclude that today's activity absolutely caused some short-term chart damage, but when we look at the big picture, a case can still be made that the multi-year correction that began at the end of 2011 and concluded at the end of 2015 is over, and that we are still in a bullish cycle. However, at this point, we are certainly in a corrective period within that bullish cycle. Traders, the last 2 trading days of this week were volatile to say the least. Yesterday, we had gold actually rise $20 before accounting for a runaway strength in the US dollar. Today, we saw the opposite, dollar in essence not having an effect, but gold moving down over $25. In terms of the analysis of the market, we can see a multitude of factors that could have contributed to it, or it could have been technical selling, but nonetheless, this week concluded with a major break below support for gold. This has been Gary Wagner, wishing you as always good trading. I am truly sorry we were unable to deliver that to you this week. We'll talk to you next week for another daily update and review. Bye-bye.